Hi guys, Tommy here from Easy Buyers Agent. Here at Easy Buyers Agent, we buy the right property for our clients. First of all, I just would like to thank you all. Thank you so much for your time to visit our webinar. I really value your time, so we will keep this short and sharp. Thank you once again for coming. Thank you so much. Before we get started, let me just introduce myself. My name is Tommy, and I'm the principal consultant here at Easy Buyers Agent. I've had more than 10-year experience in property investing and have helped friends and families along the way to purchase properties. One thing that gets me very motivated to start this business is simply by how many people close to me who have simply gone blindly with property investing. We have all heard that property can make you rich. It can lead you to financial freedom and all that. But the thing is this, right? There are a lot more that goes into it. There are a lot more that goes into it. And a lot of my close friends and relatives and families, including myself, have actually lost money in property. Instead of making money, buying into the promise that property can make me rich, instead I have actually lost money simply because of lack of knowledge and understanding of how the game is played. So this is why I started this business. That is to help people buying the right property. You see, the money is always made in the purchase. Always. You can never make a gold out of a turd. You can never make a gold out of a turd. This is why it's really important for you all who are watching. Make sure you buy the right property in the first place. Whether you want to buy and hold, renovate, build, subdivide, you have to start with the right property in the first place. So anyway, that's just a little bit about me. I currently own 5 properties worth more than $2 million, and I'm in the process of acquiring a few more. In this opportunity, I want to share with you my experience so that all of us, you and I, can become a better investor. All right, so one of the questions that my clients have often asked me is this: how do you know that you are actually not making a loss in property? How do you know that you are actually not making a loss in property? You know that you will always make money in property long term. Always, right? Always. I mean, it's set in stone. Put it this way, if you hold your property for 30 years, surely it would have increased at least double in value, right? I mean, it's just the way it is, right? But the problem is this. How do you know that you are actually not losing money along the way? How do you know that you're actually not losing money along the way? How do you know that to hold the property that long, for 30 years, you are actually not bleeding money out of your pocket? This is really important, guys. This is a really important question to answer. Why? Because if you're not careful, by the time you want to cash in 30 years later, you realize that you have actually forked out more than you thought, meaning your profit line is diminished. I'll give you an example. In 2006, I actually bought a investment property. I didn't do any calculation. I didn't do any due diligence. I just bought it just because I could, right? I still remember back then I was 23 years of age. And, I earned my first sort of like 6-figure salary, you see, and I thought, oh, I felt like I'm a big guy already, and here, then I did. I bought the property. I bought it for $440,000. $440,000. I still remember this, and the property was already 5 years old. So the depreciation that you get from the property was quite minimal already, right? And this is the problem. I hold it for 6 years. It's a negatively geared property. I bought it because I heard, that if you buy a property, you can actually minimize your tax. But this is the problem. That's the only thing. That's the only reason why I bought that property in the first place. So anyway, long story short, I hold it for 6 years. In the 6th year, when I sold it for, do you know how much? $450,000. I bought it for $440,000. I sold it for $450,000. So I only made like 10 grand there. But the problem is this: every single year, to hold to that property, because it's already 5 years old, right? There are some maintenance need to be made, and I didn't count for like the change of tenants and whatnot. To hold onto that property cost me 10 grand a year. 10 grand a year. Can you imagine that? So for me to hold that property for 6 years, it actually cost me $60,000, while I only made $10,000. You see, that's $50,000 gone just like that. This is why, guys, very important that we have to know what we're doing, right? We have to know that our property is not bleeding money out of our pocket. You see, property is very much a business, and to run a business, you have to first project your costs, revenue, and profitability. Just because you can sell a burger for $20, which only costs you $1 to make, for example, doesn't mean that you can open a burger chain straight away. Have you thought about the materials, the wages, the staff management, the ongoings, the potential downturn and holiday periods, etc.? Same with property. You just can't buy any property and expect to make money. You have to buy the right property. I can't stress this enough. So what is the right property? For me, it's really simple. The right property is this. It's a property where there is a demand of purchase. That's number one. And secondly, it's the one that gives you positive cash flow. Just those two things. For me, it's really simple. It's a property where there is a demand of purchase and it gives me positive cash flow. You probably know by now the phrase location, 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 right? This will determine your demand. But location alone is not sufficient if your cash flow is negative. Just like I just mentioned in my example there, I actually lost 50 grand cash flow, right? I mean, that's just bad. If it costs you a lot of money to hold on to the property, then that's not the right property, even though location might be great. You see, you can't bet on capital growth alone. Why? Because capital growth is affected by external factors that you can't control. You just can't control capital growth. You just never know when your property will grow in value. In 30 years, sure, it will grow in value. But what we know, what we can control is our cash flow. Because when you control your cash flow, you can hold that property for a long time and you're not bleeding out money from your pocket. Okay, cash flow is what allows you to hold onto that property for a long time. And not just that, when your cash flow is positive, banks would love to give you lending, thus allowing you to buy more property. So in this webinar, this is what we're going to delve deep into, right? It's the cash flow of a property. It's the cash flow of a property. What is cash flow? Cash flow is simply the flow of money in or out of your pocket. If the flow is coming into your pocket, it is positive. If the cash flow, if the flow is coming out of your pocket, it's negative. Now ask yourself this question, especially those who have had investment properties already. To own and hold onto this property, is my cash flow actually flowing in or out of my pocket? For us here at Easy Buyers Agent, we simply don't buy a property that will give us negative cash flow. Tommy, how do you know that, you may ask? The answer is simple. Do your due diligence and numbers. Here at Easy Buyers Agent, we have developed a calculator that will give us the final cash flow figure. This is actually part of our pre-purchase process so that we have actually minimized risk as much as we can with any property we buy for our clients. Sure, the number may not be 100% accurate, but what I can tell you is this. I am very defensive in my calculation, very defensive, so that, you know, if let's say worst come to worst sort of scenario, worst come to worst, that's the sort of figure I'm looking at. That's the sort of cash flow number I'm looking at, right? I'm planning for the worst. Why is it really important? It's because if I can cater for the worst, and in the real world, let's say the worst doesn't happen, then I actually know that I'm actually returning better. I'm actually earning better income with my property. So this is why it's really important, guys. Cash flow is king in property investment. Cash flow is king. If you keep bleeding out money, banks wouldn't lend you, right? It's the same as if running a business that keeps losing money every single day. It's just bad. Okay, so anyway, let's just get into this, and I'm gonna show you. This is the calculation that we are doing here internally at Easy Buyers Agent. Okay guys, this is the calculator we are using here at Easy Buyers Agent. All right, I'm gonna run you through how we are doing the calculation for our cash flow. Okay, I've reset everything to be 0, so let me just walk you through it. All right, now I will start with the rent per week. Rent per week, I've contacted the property manager around the area. This is a real life scenario, by the way, guys. This is one of the properties we purchased for our client. Okay, the rent per week. So we've contacted the property manager is about 450 bucks. Okay, it means that annual rent you will get about $23,400. Now, land price, because this is house and land. Let me just write this down so we don't forget. House and land, right? 4 by 2 by 2. So 4 bedrooms, 2 bathrooms, and 2 car garage. Okay, land price was $190,000. Build price, so I've contacted my builder and it's about $200,000. Okay, asset borrowing. Okay, so I am going to borrow 90%. I'm going to borrow 90% from the bank. I know some of you are borrowing 80% because you try to avoid the lender's mortgage insurance, which I'm going to explain to you a bit later. But why am I borrowing 90% is because as an investor, instead of putting 20% and just buy one property, I can actually split it into 10% and 10%, meaning that with 20% deposit that I have, I can actually buy 2 properties of the same value. Does that make sense? All right, so 90% borrowing is about $351,000. That's of the 390, and then LMI, I think, cost me about $7,500. Now with LMI, you can go to Google and find an LMI calculator. So LMI is basically what the bank will charge you if you borrow more than 80%. So if you've got a 20% deposit, you will save 7,500. But again, for me, I would rather pay $7,500, but I can buy 2 properties with my 20% deposit. Does that make sense? Okay, total borrowing, it means that LMI, I can actually put this into the loan. I think the bank normally puts that into the loan. So total borrowing will be 351,000 plus 7,500, which is 358,500. Okay, upfront costs. Now this is the thing. When you buy a property, you've got about 5%. I know it's actually not 5%, it's less than 5%, but here in this calculator, we try to be as defensive as we can. So I just put 5% of the land price. What are upfront costs? This is costs like stamp duty, title search, and all that sort of stuff. Okay, 5% of the land price, because this is house and land, so I only need to pay stamp duty of the land price, right? If you buy a built property, established property, then you have to pay on both the building and the land. All right, in this instance, it's just 5% of $190,000, which is 9,500. All right, no rent for first year only. What this means is, because the house will be building and I will start to pay the interest, right? So this is why I put this as a cost. 6 months, this is not right here, so I need to do this times by 4. All right, 6 months of no rental income, right? It means that it cost me $10,800. $10,800. All right. I've got the Easy Buyers agent fee here of 2% of the purchase price. This is the purchase price and the build price, right? 2% of that is $7,800, right? So in total, my deposit needed is $67,100, which is this plus this plus this plus this, and plus the asset, plus the borrowing deposit, right? Why do I calculate it this way? Is because the upfront costs, obviously the bank will only lend you the money for the asset, not for the cost, right? So this cost you have to come up with cash, right? With this is the 10%, which is $39,000 plus all this upfront cost, $67,100. Now you may ask, why do I need to pay you, Tommy, for 2%, right? The reason is because I've been able to negotiate this price. The land price was $220,000 originally, and managed to buy at $190,000. So that's already $30,000 off. This is why I think using a service like us, we know how to negotiate. Well, I think if you go on your own, if you're good with negotiation, by all means, right? But not just that, this property, really close to amenities, 200 meters from a bus stop, 2-minute drive to the freeway entry, 2-minute drive to the big shopping center close to the area. So it's really prime area, really prime area. And at the same time, we've been able to negotiate $30,000 off the asking price, and it's actually below the market price. So this is why I think, um, you know, this is where the value of using a service like us comes in, because we not only just buy any property, we buy the right property, right? Location and cash flow. But anyway, let's just continue on. Okay, annual interest rate is 4% of the total borrowing. Okay, total borrowing 4% is $14,000 $340 per year. Now rates. Okay, so when you buy a property, you have to pay annual water rate, annual land rate, and if you buy an apartment, you have to pay strata fee. In this instance, I have no strata fee, so it's just the water and land rate, which I estimate about $3,000 a year. Normally about $2,000 for the land, and water rate is about $1,000, right? $3,000. Insurance, you've got landlord insurance, home insurance, because I'm gonna rent this out as an investor. So I need to be paying insurance, right? Let's just be very pessimistic and put this number to be really high. Let's say 2,500 per year for my insurance. Property manager, 10%, 10% of the annual rent, right? So 2,340. Now maintenance, because this is a new property, you may not need any maintenance, but just in case, let's be very defensive in our numbers. Put this 500 bucks. All right. Now, 2 times letting fee. Okay, let me explain to you what this means. I am assuming here that within the year, there will be 2 times that the tenant will change. And normally when there is a change of tenant, the property manager will charge 1 week letting fee, right? 1 week letting fee. So 2 times, I'm assuming if the tenant goes on for the whole year, that's perfect. That's the best scenario. But let's say the tenant, I don't know, doesn't like the property or whatnot. I don't know what it is. Let's say, they want to move out, then I have to get a new tenant, then I'll be charged a new letting fee. So I assume 2 letting fees per year. Okay. And vacancy rate. Now, vacancy rate means even though you may have the tenant for the whole year, for example, but there may be um, some period where the tenant going overseas and whatnot, and sometimes they will try to negotiate, oh, can I just not pay the rent while I'm away? So anyway, I am putting 6% vacancy rate, and also not just that. Let's say there is a change of tenant. It's also the period um, of it's the period where you actually can't get the new tenant straight away, right? It's that empty period. So I put it as 6% for the whole year. It cost me about $1,404 a year, right? Now I will then calculate all these expenses. This is my running expenses, right? This is my property running expenses. Cost me about 24,984 per year annually. Annually, if I buy this property as an investor, this is how much it will cost me to run it. Okay. Now the rent price that I'm getting, is 23,400 based on $450 per week rent. So it means that I get a negative gearing of minus 1584 per year, which is not too bad at all, right? Given that the property is a really good location. 1584 meaning that you're only negative negative gearing for 100 odd bucks a month. It's nothing, but this is the thing. This is now the key, right? This is the key. Check this out. This is my tax return. This is how you calculate the cash flow. Okay, so far I need to fork out 1584 per year to run this property, but at the same time I can offset all these expenses that I've paid upfront at the top, all these expenses, right? As well as my negative gearing, I can offset it against my tax, okay? And not just that, the building depreciates. The building depreciates, and according to ATO, I think if you buy a new property from 2017, 2018 onwards, you have to check with your accountant, by the way. You can claim about 2.5% of the build price. So that's 2.5% of the build price, which is $200,000, right? 2.5% is $5,000. So the tax return on my depreciation, given my 40% tax bracket, for example, is about $2,000. Okay, this is my tax return of the building depreciation. Say this is like a free money. How good is this? How good is this? Now, because I'm negative gearing, okay, I will get a tax return of my negative gearing as well, right? So 40 cents in the dollar of that, I get $633.6 tax return. Okay, and finally, the holding cost and the fee upfront. Okay, so all this fee, right? I can offset it against my tax. Also, I get a tax return about $11,240. Okay, so in total for that year, I get a tax deduction, a tax return of 13,873.6. Remember, to run the property cost me 1584, right? But now, after I deduct all the costs and everything, I get a tax return of 13,873.6 for the first year. Meaning my cash flow is 12,289.6. How good is that? How good is that, right? And not just that, because now that I've offset all my costs, I can no longer offset it against my tax, right? So for the upcoming year here, as you can see, this is year 2, year 3, year 4, year 5. So this is what we provide to our clients so that they can see in 15 years what sort of cash flow position they're in, right? On the next year, right? Because I no longer can get this nice big tax return for the costs, right? On the next year, I only get a tax return of the of the building depreciation and the gearing, right? And the gearing. But as you can see here, check this out. Every single year, I get a positive cash flow. Check this out. How nice is this? How nice is this, right? And not just that, I have actually factored in a 2% inflation, because as you can see, prices go up, rent price will go up, as well as the cost, right? The insurance and everything, land rate will go up by inflation rate, and yet my cash flow positioning is still very positive, right? Obviously, if interest rate goes back to where where it was like 8-9%, surely the cash flow would have been negative, but at least at the moment, the interest is pretty low, and it will take some time before the interest goes back up to 8% again, right? But during that period, because I am earning positive cash flow on my property, I can put this into a buffer account so that when the interest goes up, this positive cash flow would have covered the negative cash flow that would come in because of the interest rate, right? So as you can see here, guys, I am minimizing my purchase. I am minimizing my risk as much as I can. Obviously, these numbers are very, very defensive, meaning that at the very least, right, given all these vacancy rates and letting fees and whatnot, I am still positive cash flow. I am still positive cash flow. This is really important, guys. This is really, really important. Meaning that if the scenario is actually not as bad as I thought, let's say the tenant, instead of 2 times letting fee, it becomes 1, this will just become even more positive. How great is that, right? And as part of this calculator as well, I've also included the cash on cash return. Cash on cash return, it just kind of shows you whether it's worth it or not to invest in property, or whether you should put your money into other investment vehicles like shares and whatnot. So as you can see here, given the capital growth of just 4% on this property, my cash on cash return is like 25% plus, right? 18% plus. So would I invest anywhere else? Looking at these numbers, absolutely not. I will just keep buying properties. So as you can see, guys, buying the right property is the key. It's non-negotiable. Property is a big purchase. Might as well do it right. Okay. So before I close off, I thought I just want to mention this. If you wish to use the same calculator as we do here internally, you can actually purchase the calculator. It only costs you $11. Very, very cheap. But remember, this calculator is what allows us to analyze our projected property purchase before we buy. Remember, this is all about minimizing risk as much as we can, so we know what sort of numbers we're dealing with. Okay, but other than that, I thank you so much. I thank you so much for your time. I hope this webinar has been valuable. And if you need more information on the kind of service we provide, please call or email. Remember, we stand by you as a property buyer and investor, and we make sure that the property we help purchase is the right one. Thank you once again, everyone. I'll see you next time.